Hello again, this is Stephen Wilson, and I'm running for Congress in the Missouri 3rd District for 2012. I'm a libertarian, and the purpose of this video is to explain a possible solution to some of your comments about the free trade agreements. I am not going to teach you the Ricardian model, which is a reference to David Ricardo. Normally he is something that people teach their students to understand what's called the comparative and the absolute, and what we identify as the opportunity cost from one product to another. I am not interested in being your teacher. As I mentioned, my campaign is about offering solutions, which is what I'm going to be doing for this. There is a point in the Ricardian model that you don't trade, and I'm not going to talk about that point, but I am going to acknowledge that that is the foundation, that it has already been proven in the algebraic from one cost to another that there is a point that you don't trade, and that's because the opportunity cost can be found in the number of unemployed people from country to country. So here, as you're looking at the screen, we're going to be looking at a possible solution here, and again, I'm going to be using financial anchors to remove the corruptive nature of the body politic and the Commerce Clause. There are basically two rules for this game. Number one, this will be a hard set relationship between the exchange rates of currency between the countries that are trading and the national unemployment rate of those countries in that trade. And number two, we're going to let the market pick the winner and the loser in regards to a profit loss mechanism. Everybody knows that capitalism is just one kind of market device, but in regards to the macroeconomic game strategy, we know that profit equals the loss, because loss is what helps us clean companies that really shouldn't be there, or product service caches that are no longer required by the agents in that particular market. So we're going to let the market do its job and let the people through the market device pick the winner and the loser. To go a little bit into depth in this, to get away from theory and move into the applied science, I'm just going to go through a real quick example. And to go ahead and set this, normally when you're talking about exchange rate manipulation variables, you're talking about the relativity and the correlative nature of appreciation and depreciation of the currency. But we have to acknowledge our foundation, and that is going to be that currency of a country behaves like a share in a publicly traded firm, and the unemployment rate would be identified in the opportunity cost of lost production. So here we go ahead and we identify that the unemployment rate is X. We identify the rate increase, and then we change the rate of the currency to strengthen the currency against other currencies. Now, the reason that we want to strengthen the currency is because we want to make it more difficult for trade to take place between those countries, because we want there to be a balance between the people that are employed and the production levels therein. Even though we acknowledge that countries are built differently, again, the purpose of this is to identify fair trade, not free trade, because there you would be dealing with the alpha male, and you would be dealing with those that are meant to be on the menu. Now, to get into an actual real-time example, as you see on the bottom of the screen, the unemployment is currently at X. The exchange rate is currently $1 to 2.5 yen. If the unemployment rate in the year were to raise an average of X plus 2, which, let's say for example, we set the hard unemployment rate at 5. So at 5%, we identify the unemployment rate average from January to December increase to 7%. Here we would have to take that as a multiplier, and the US dollar to yen ratio would be from 1 to 5. Now again, the main purpose here is to make it more difficult for American and Japanese goods to move, because even though there's no way for us to make a direct correlation between one country causing a problem to another, we do know that when you have economies of scale, there is a relationship in the global theater that has to be acknowledged for what it is, and that is that you have people that are better at it than others. When you have a mature economy like America, we know that we have the ability to outproduce others because it is pre-existing. We look at our transportation, we look at our education. These things are identified as advantages. But we also have a disadvantage in regards to the cost of living index. So when you go into a country like Malaysia and you identify that one agent in that market could perform a task per week for, let's say, $85, that same task in America would require somebody making $750. Well, that differential can be identified not only in the formulations in the algebraic or the abstractions, but you're also talking about real time. Because when a company takes their labor into another country, that lost production has to be acknowledged somewhere, and that's going to be in unemployment. And so therefore we go ahead and we acknowledge that the people that puppeteer the market device, we need to remove their ability to manipulate the market, and we need to let the people that have the purchase power decide who stays and who goes. And when we deal with countries that can do something at a much lower wage, we need to be able to deal with them, and we have to use an anchor. And that means that we're going to have to level the playing field in the only way that we know how, and that would be in the currency. And that's going to help us understand the relationship from country to country. I hope I explained that in a way that you could understand. Macroeconomic can be a little bit difficult, but micro is much more complicated. So again, this is Stephen Wilson, and thank you for your time.